I'm going to go ahead and kick off. I'd like to welcome everyone to the Northeastern Region Tax Roundtable's 2022 Trends Reshaping the Accounting Profession. My name is Peter Scalise. I'm the chair of the Northeastern Region Tax Roundtable. And I want to first take this opportunity to thank our esteemed panelists on today's broadcast and our sponsors for making this broadcast possible. I want to thank Infinity Globus, the global leader in staffing augmentation solutions, including co-sourcing and outsourcing. We're gonna have some exciting discussions with them today. Capstan Tax Strategies, as well as Profitopia. And I would want to also acknowledge the number of people that are participating on today's broadcast. It's going to be a tremendous lineup. Our first guest panelist is Alan Colton of the Colton Consulting Group, who I feel is the foremost thought leader in the M&A space of CPA firms with private equity funding and SPAC structures. He's going to talk about the state of the profession with all the mega mergers going on, as well as merging of mid-sized firms and PE equity funding, along with the staffing shortages within the United States. I think a lot of people realize that with the baby boomer bubble, we have approximately 330 million Americans in the United States, and 70 to 75 million fall into that baby boomer category. And there's just so many great thought leaders that are retiring all at once, coupled with not enough newly minted accounting graduates coming out of school, is creating significant staffing shortages. And it's leading to really one of the more significant impediments to growth of firms. So I'd like to welcome Alan. And Alan, maybe you could kick off with maybe what you're seeing as far as trends and opportunities and challenges, if you will, within the profession. And perhaps you can make some bold predictions for us on today's broadcast.
Well, thank you, Peter, and thanks to the group for having me today. And boy, what a crazy time to be in this profession. I think we did one of these calls a couple of months ago and we said it was crazy then. Well, guess what? Double that. It's that crazy. And the question that just seems to be so popular and going around is, when is it going to end? Meaning, when is the war for talent going to slow down? Because right now the advantage goes to talent, the disadvantage is going to the employer. And I'm just here to give you some really uplifting news, hot off the press. It's going to get worse before it gets better. If you look at whatever numbers you want to look at, the enrollment of kids coming out of school is down. It was, I think, 10% last year. The supply of talent, this is my prop for today, this is the supply, that's the demand. And we'll talk more about that shortly. Since April 15, I probably do about 4 partner retreats a week, and it's beginning to be like a broken record. Everything is great except for the inability to find, keep, and grow talent. And you know what we're doing is we're throwing solutions at the problem, no different than we've done for the last 10, 20 years. And my message today is that's not good enough. It doesn't work. You know, if you think about this profession, put the talent side aside for a second, think about what we do. So I'm the oldest person on the call, I can tell you that. I've been doing this for 42 years in this great profession. And I would tell you that the profession is about 140 years old, if you think about it. And back in the 1880s, 1890s, there was a Mr. or Miss Waterhouse, Anderson, Young, and maybe a Deloitte and someone else. And they put up a shingle and said, we're open for business. And we're going to do 2 things. We're going to offer services that clients don't want but need. And that's called a financial statement and tax return. And we have been riding that horse for over a century. The disruption today is here. What is fascinating is so many firms don't see it. I would characterize our accounting profession in the US at 45,000 firms. I would say there's a third that understand that transformation is in the wings, and I'll be talking about the 4 T's: transformation, talent, technology, and trouble. And I use the word trouble because I think there's an upper third that gets it and is investing deeper and differently than they have in the past, and I'll talk about that. I think there's a third in the middle that have what we call a partnership structure and the inability to align and make the tough decisions they need to make. And I would say the beauty of public accounting, I think there's a third of the firms, they just have their head in the sand. And they're just doing what they've always done. And lo and behold, 2020, for most, record year. Hey, that's pretty cool when you can take 15 months of revenue, turn it into 12 months, and not spend any money. If you couldn't have a record year for earning in 2020, you need to leave this profession. Something is majorly wrong. But 2021 came about and we said, we got this. This thing called remote, we figured it out. This thing called offshoring, getting work done at a lower labor rate, you know what? This actually has legs. So many firms I work with, when I talk about offshoring, they are quick to say, we tried this and it didn't work. You got to love accountants. And I'm one of them, so I can make fun of me in the same breath. I say, well, when did you try it? They said 20 years ago. I said, what'd you do? They said, we sent 110 40s over and we weren't happy with the results. I said, well, that ship has sailed. It is vastly different today. Let me talk to you about my son, Brian, who's going to be working in transaction advisory starting this summer at a top 5 firm, RSM. I put Brian through an audit internship at a national firm, thinking he'd be like his dad, a great auditor. He had zero interest in that. He said, Dad, the work is mundane. It's not challenging. I said, well, how do you know that you're an intern? He says, because I talked to the people a couple years older. It's just not challenging. I said, listen, forget about audit. I didn't want you to be an auditor anyways. Go into tax. Tax is like a brain and heart surgeon. I mean, it's cool. It's sexy. He came back. He said, Dad, he said, I talked to the peer group 1, 2, 3 years into it. You know what they tell me? They do the same thing over and over. And as one kid said, he said, I don't have to do 1,500 tax returns to learn how to do one. I can do 15 and I'm set. Well, eventually he went into transaction advisory. And here's part of the problem. It's 3 things all at one time. 1, the supply is not enough for all of us to grow our practices. So it's a winner take all, and there's going to be big winners and big losers. Number 2, some firms have invested in outsourcing talent from other countries and found a labor pool to get the work done. And here's the secret. It's getting done better than our own people can do it. And it's getting done on time at a lower price. But I would offer up today, this is not about making or saving money. It's about, if you want to keep stars, you have to be. Now, you don't have to have stars, right? You could have average people. Because those average people, remember I talked about doing 1,500 tax returns over and over? They'll do it as long as they're paid fairly and can control their hours. But if you want stars, you've got to be able to take your practice, a compliance practice, and grow it into the consulting and advisory and outsource services that talent wants to be a part of today. So not only do we have not enough talent to feed the audit and tax group, in the accounting firm, we have other alternatives for these kids to do. And they're migrating to those consulting and advisory services. So when I talk to firms about the war on talent, they go, oh, we use a couple of recruiting firms, we go on LinkedIn. And you know what? If you're doing the same thing as everybody else, good luck with that. It's not going to work. You have to break the mold. You have to figure it out. Time won't permit us to drill down on this war on talent. But I would start by offering one thing and asking you, the partners at your firm, what matters most. When partner compensation comes, what's valued more? 1 hour of billable time, 1 hour of new business origination, 1 hour of technical handling a client base, or an hour of going out and stealing a star from another firm? I'm going to guess the last one you don't do because you don't think it's your job. People, we are not in the accounting and tax business. We aren't. Those are things we do. We're in the people business where the assets go home every night. Let me move into this transformation. I talked about 140 years ago. I think the gig is up. I think technology is replacing more and more and more what we historically used to do. And we should be welcoming that, the ability to go from being a trusted advisor to our client's most valuable advisor. But for many of us, the feeding at the trough is so good right now. We've got our heads buried in the sand, and we can't see the change and the dynamics happening if our life depended on it. And why would we? 2020 was a record year in earnings. 2021 is better. And in looking at many of your firm's financial statements for the first 4 months of the year of 2022, it looks like another record year. These were the best 4 months in our firm's history. If I've learned one thing in 42 years of being with and living with accountants, we don't like change. We don't like our world disrupted. We are creatures of habit. We don't like risk. So you put somebody in a scenario where the status quo is better than the change itself. Good luck trying to see how this industry is changing. What's the big thing getting talked about? I think it's private equity, and it's the explosion of mergers and acquisitions. We started on this journey with private equity back 15 years ago. You can imagine that. And I think it might have taken back then, if not for us doing it the summer of 2008. I think many of you remember what happened. The capital markets closed, and a lot of other things closed as well. Private equity tried to enter again in 2012, ironically 10 years ago. And you know what the message was? It's so interesting. The message was, we don't need your capital because we're not a capital intensive business. We do financial statements and tax returns, and there's a limited spend of what we're going to put into technology, and we can get away with it. 10 years later, I look at firms and the investment capital they need to put in, and this thing called a partnership just doesn't have it. You know, private equity, as you know, it's a simple formula. I'm sure you know this with your clients. It's EBITDA times multiple. Well, in our industry as partnerships, we don't have EBITDA, right? We pay it all out as income. So many firms, probably about 98% of them, are asking the question, could we or should we go the way of private equity? And the truth is, the answer is no, because they just aren't profitable enough. The perfect candidate for private equity is the following: a firm that makes a lot of money, a firm that has a great story to tell, a firm that to some degree sees the fatal flaws of a partnership model and wants to go to more of a corporate model. And if you don't think there's flaws in how we as partnerships make decisions, take out a blank sheet of paper. Think about the last decade. Any tough decision, did it get made? How long did it take to get it made? And was it watered down and probably had no relevance by the time it got made? Now, I've had literally firms of all size fill the whole page of paper and turn it over, and then they chuckle and they said, you're right. We as partners try to please everybody. We read the tea leaves, and if one or two don't want to do it, we back off. It is the worst governance model ever created, but that's us. So PE sees an industry where we need capital. What do we need it for? We need it for the war on talent. Every day somebody is calling with a story, and I say to myself, you can't make this stuff up. Somebody's making 90,000 and they just got offered 200,000. Somebody's making 72 and they got offered 150. Somebody's making 300 and they're now making 500, and they're being brought in as an equity partner. This apprenticeship of stay out of trouble, do the work like a dog, and in 10 to 12 years, you too could be a partner, throw it out. What private equity, I think, has also exposed is this thing we call the unfunded chain letter. Now, I was a partner in a CPA firm. I thought it was pretty cool that I could make a good income over my career. And then when I retire, get paid 2 times my compensation. Now, it's going to get paid over 10 years after I retire. It's going to be paid without interest. It's ordinary income. The kid today who's 35, this is what he or she says to me. You know, if we stay as an independent firm, we're going to have to retire out all the baby boomers. And the truth is, who's going to take care of us? And are we going to spend all of our money paying them out? At the same time, we're going to have to invest in technology, talent, transformation of the business. Where's the money going to come from? It's called partner compensation. So what if we spend all our money the next 10 years and we guess wrong, or it doesn't work quite the way we thought it would? Here's the alternative, and this is what private equity would say. Come join us. We're going to form a new company. We'll call it NewCo. And in it, we're going to make you an owner. See, what they would say is not all, but some of the consolidators of the late 90s, like H&R Block and American Express, you know, I don't want to include CBiz in that because while it may have taken them some time, I think that firm is thriving and they've figured out a model for non-CPA ownership, and it's working incredibly well. But for the most part, what it was a way to monetize the old group with nothing for the kids. But what the kids are saying to me today is, look, I'm 35. If I retire and get my vest and the firm's still around and our profession's still around, that's age 65. That's 30 years from today. And then you're going to slowly pay me without interest, ordinary income over 10 years, 2 times my comp. Why do my clients sell their business for 6, 7, 8 times multiple and get capital gain at closing, and I get nothing? I think the new reality is we have an asset. We've just never thought of it as being an asset. And as it's cute, the young kids, they call me Mr. Colton, and they take out their Texas Instruments calculator and they show me this button. It says present value on it. And they said, you want to know what 2 times compensation is 30 to 40 years from today of ordinary income back to today? I said, what is it? They said, lunch money. That's what it is. And if you think that's the stickiness for our generation, you're wrong. So what we thought was a privilege, a prize, this unfunded deferred comp of 2 times, what are they saying to me? And I've sat in these meetings with these firms that have done these PE deals. They're saying, look, I get a check today, a decent sized check. If we hit these milestones in 3, 4, 5 years, I get another one. And then I've got rollover equity, a disproportionate share because I'm not getting as big a check as the old group. And they're betting more on me. And we're going to together, we were aligned on our goals. We're going to someday sell this in years 5 to 7. This is a great thing. And we need the capital. So I would make a bold prediction, Peter. You asked me for one. 2 of the top 20 firms have announced private equity deals, Citrin Cooperman and Eisner Amper. I will tell you by the end of the year, and Peter, I'm going to bet you a steak dinner on this because I got inside information. There will at least be 3 more in the top 20 that will go the way of private equity. And if we were on a reunion call a year from today, I would dare say I think 8 of the top 20 firms, not including the big 4, which means 50% of the next biggest firms will have gone the way of private equity. The times they're changing. M&A deals are being completely disrupted today. If you read the accounting literature, I think we're averaging 1 M&A deal almost a day. I thought it was ironic. Yesterday, we announced a deal with Baker Tilly acquiring a great $20 million firm in Seattle called Bader Martin. And there were 2 other firms on the same announcement. And when I called accounting today to say, how come you didn't give us exclusive? They said, there's just too many of them. We can't. and that is not going to go away. Who do I feel sorry for? We talked about baby boomers. I feel sorry for the $2, $3, $4 million firms where they've sort of milked it for everything they can. And someday they said, we'll sell it. There's no takers. There's no buyers. The firms today are migrating towards bigger deals because there's so many of them. And they're also looking to buy non-accounting firms, consulting, advisory, wealth management, outsourcing accounting, outsourcing tax. outsourcing technology, outsourcing payroll, you name it. That's the wave, not of the future, but of the present. So I think you roll all this together. I mean, let's just talk a minute. I know I'm coming up on time here. Good hygiene. You should have more business than you know what to do. If you don't, call me after the call, because we have to have a different kind of conversation. Everybody's growing. We don't have the talent. Yet I go in and I see some firms took on the sacred cows. They truly got rid of the crappy clients, the C clients. Why? Because they need to spend more time on the A clients, because there's more revenue to be gained and there's more referrals to be got. But for some of us, we're creatures of habit. We're grinding the same thing over and over, raising rates, getting rid of crappy clients. And if you can't get rid of crappy clients, I got an idea for you. As long as they're not jerks and our people don't think when they get assigned to them, it's a message from you to maybe look for employment elsewhere, double the rates. You'll keep the revenue and you'll have one half the hours. If ever there's been a time for strategic planning, transformation, I mean, just think about this. Talent. It used to be you recruited talent in your own backyard. They had to physically be there, bricks and mortar. Bricks and mortar are gone, right? You can recruit anywhere, but your competition can also now raid into your firm and they don't have to be in your market. The same can be said about clients. You don't have to meet them in person anymore. I used to think it was a rite of passage. It's not. And if you have a specialty, a service line or industry specialization, let's begin marketing outside of the geography we know. And that's the good news. The bad news is competitors are going to be coming into our market with our best clients and going after them and leading with industry specialization. So Peter, I'm coming up on 20 minutes. I told you we wouldn't go past that. I know you said you have an electric prod or shock you would do. So I'm signing off, turning it back to you. Thank you.
Thank you, Alan. Incredible, insightful presentation. I agree wholeheartedly. You know, you're looking at the landscape of the top 100 firms, the top 50 firms, top 200 firms, and the advent of the private equity funding as well has just been tremendous. I remember at the turn of the century, it was really, I remember the banking industry was going into it with the American Express Centurion Bank at the time buying out Goldstein, Gollop, and Kessler, which is ultimately, you know, sold into RSM when it was part of H&R Block. And I remember even HSBC funding the former Arthur Andersen partners when they started WTAS, which later got rebranded Andersen Tax, then ultimately Andersen. So it is amazing, these trends that we're seeing and living through. And I do believe that we're going to continue to see the landscape change quite rapidly before year end and into the next few years. Maybe lastly, Alan, you want to talk a little bit about what you're seeing with the accounting firms with non-equity ownership and the rise of the advisory practices. It seems like all the accounting firms today are spending significant time and resources to build up those advisory arms.
Yeah, and I'll go quick on it. So on the non-equity, clearly the fastest growing position in accounting for today is a non-equity partner. We used to have one size fits all. You either had to make the big jump to be an equity partner, and the younger generation has pushed back and said, I don't want to work the crazy hours you do. I want to have a life. And what we're finding is the title of partner, we don't ever have on business cards, equity partner, income partner. The title of partner is a distinction that one wants to get. So we're creating a whole new universe of non-equity, called income partners. Most of them don't put capital in the business. They don't want the risk. Most of them don't get anything on the backside, although I will tell you, I'm starting to see a trend where they're getting 1 times their comp paid out over 10 years at retirement, just trying to create a little stickiness. And who are income partners? There are former senior managers. We're giving them the title of partner and seeing how they can perform. And if they can grow to the next level, they become an equity partner. There are some that will become income partners, and that is their final resting place. And we also use it as a recruiting tool. If someone is a partner at KPMG, LMNOP, just being funny, they're not coming to our local or regional firm as a senior manager. So they're going to come as an income partner. We're going to work together, live together for 6 months to a year. If it works, we'll move them into a equity position. And then the transformation, most firms I work with today, 3-4 years ago, they were 45% tax, 45% audit, 10% consulting. Today, they're migrating quickly, like the sound of speed, a third. And they're leading with the consulting and advisory services. I'm sure you saw what PwC did last summer. They said, you know what? We're going to take all compliance work, whether it's audit or tax, and we're going to move it into a new entity called trust. Then we're going to take everything else, the value-added services, the services the clients want and need, and we're going to put that into the value division. And, some said, this is being done to set it up for sale. I don't know if it is or isn't, but I think it's a sign of our times that clients today demand value. And if we can deliver it, they'll pay anything for it. They're like lost in the desert. There's a mirage and they're looking for water. What's the water? It's our ability to provide value-added services. And I'm seeing more engagement letters finally rewritten where it says we're going to bill you for the greater of value or the hours we incur. Thank God it's long overdue. Thank you, Peter.
You're most welcome, Alan. Thank you so much. Maybe, Appa, you could launch the first polling question before we get to hear from Vivek, Yash, and Amit from Infinity Globus. I think one of the ways to look at the staffing shortages in the United States is to consider global outsourcing. And of course, the big four, back then it was the big six accounting firms in the 1990s, really started that trend. I remember Ernst & Young in the mid-1990s actually started the movement of work sold out of New York into the Midwest. They had a compliance center in Indiana. And then 2 years later, they moved it to India. They were at really the forefront. By the late 1990s, all the big, call it back then, I guess if we go back to the late 90s, you're looking at big five at that point with C&L and Price Waterhouse merging the summer of 98. So by the time the late 90s were over, you had 5 firms left and they were all in India at that point. And now you're seeing the gravitation of the top 25, top 50, top 100 firms having resources all over the world. So maybe let's maybe launch the first polling question to take a look at what our audience members are doing as far as outsourcing, if they're currently doing it, if they're going to consider it.
Sure.
And see what the responses are.
Yeah, I'm launching it. Sure.
Fantastic.
So the poll is about if you not plan to co-source or outsource some of your accounting firms, bookkeeping, attest services or tax compliance service in 2022. So everyone has started polling, Peter. So
excellent.
Yeah. So let's wait a bit.
Looks pretty close.
Yes.
Those percentages.
Yes,
looks very close.
Very close, yes.
Very close. Maybe Vivek, you could discuss the landscape of what you're seeing, and maybe talk a little bit about your vision as one of the thought leaders that created the Phoenix Institute, Infinity Globus, and building it into this very large scale compliance hub.
Yeah, thanks, Peter. And let me thank Alan for a great thought on the co-sourcing and the outsourcing and the staffing solution. So very impressive thought, Alan. Thank you so much. Peter, regarding the Infinity Globus, that is the extended team for the any CPS firm and the ES firm in the US. We all know we are struggling with the staffing, whether it is India or USA, we are struggling, okay? And we need the new youngster, okay, coming to the industry. And we are entering those youngster in the industry. The academic is never be enough. We need some kind of the skill development courses, and that is all about the Phoenix. So Phoenix is focusing on the skill development courses with the dummy 50, 60 tax returns, dummy 30, 35 QuickBook accounting project with the different industry. We are training the new graduate, new Indian chartered accountant, new CPAs for the skill development and the continuing professional education. And we are allowing them to enter in the industry, and that is the purpose of the Phoenix. And the Infinity Globus is not struggling with the staffing only because of our Phoenix Institute. Okay, so Phoenix is the academic plus the skill development courses, and that is the future of this industry. The new people, new youngster must join the industry, US tax and accounting with the proper skill development. Peter.
Fantastic. Yeah, we got a question from the audience. It's asking, what would the ideal process of co-sourcing and outsourcing be?
Yeah, Peter, let me answer that. And really, I love this word co-sourcing. Okay, this is really the latest version of the outsourcing due to technology and the so many other stuff. Okay, when I started my career in 2002 with the Sure Prep, and then the people are sending the backup file to the India. We are restoring here. We are preparing the tax return, then again sending back the backup file. So that was the old fashion of the outsourcing. But now due to technology better, it is the co-sourcing. And why the co-sourcing? Because your extended team is working, okay, whether in the US or maybe outside the US, maybe in the India, but that is your extended team. Only the difference is they are not sitting in your office, they are remotely connecting your server, coming to your environment and working just like your in-house staff. So that is the extended team working remotely, and that is the why I really like the word co-sourcing. Nowadays it is the co-sourcing, not the outsourcing. Only thing, the few points I would like to discuss here, Peter. One is, the first, we have to measure our requirement, the goal, the need of the co-sourcing partner and the outsourcing partner. What are exactly the requirements? What exactly we wanted to keep in-house? What we exactly wanted to outsource? And if you ask me that anything where the client communication, client facing is required or front desk is required, it must be managed in-house. Anything back office work, preparation of the account in the QuickBook, payroll processing, income tax preparation, so many other steps, income tax review, finalization, everything. In audit also, the preparing the work paper and the doing some work papers, calculation, setting up the financial, trial balance creation, so many other stuff. So we have to first differentiate what we wanted to keep in-house and what we wanted to outsource to our extended team. That is the first thing we should consider. Second, very important, contact the right outsourcing or co-sourcing partner, evaluate their capabilities, their continuing professional education, and so many other steps. So that is second step. Third, okay, each and every provider is providing the trial work. So before you commit anything, first just do the trial work. Test the process, test their quality, everything. They are providing 15, 20 hours, 25 hours trial work. Before committing anything, just assign them the trial work. No obligation, no commitment, trial work. Fourth step, once you are happy with the trial work, select the right engagement model based on your need. Sometimes you need the seasonal work or maybe a periodic work. So you can take the ad hoc model for accounting, ad hoc model for the tax return, and they charge you based on the hours or a number of tax return. If you have a full-time requirement, they can give you the dedicated full-time staff, starting with the bookkeeper, accountant, tax preparer, tax reviewer, tax manager. Decide your need first, okay? And then select the proper engagement model. Once you engage, periodically communicate with your counterpart, your expectation, any review points, any area of the improvement. So first 3 months, you have to properly sync with your outsourcing partner or a co-sourcing partner. And I think that will give the best results. So this is the simple few steps you have to follow, right? Before you go for the co-sourcing and outsourcing better.
That's fantastic. And I think, a lot of this has to do with also subject matter expertise. So perhaps a firm doesn't have experience with maybe some international tax filings or doesn't have experience with some accounting method period planning changes. Your firm could assist with that, which is very helpful. Because if your firm doesn't do it in-house, to be able to have a strategic partner in the marketplace to be able to collaborate with and co-source with is so important. And again, with the staffing shortages in the States and firms trying to grow and meet client due dates, I think it's so important for firms to consider that. We've got another question that's come in from the audience, our participants. And it's basically asking what measures should be considered when investigating the market and potential strategic partnerships.
Perfect. I think the Amit and Yes can answer that.
Yeah,
Sure.
sure, sir. We can answer this. And so considering the measures, there are some of the important measures that should be considered while selecting and investing the potential and strategic partner. The first and foremost is the security measures they have in place, because we deal with the sensitive clients' data. So the important point is to know about what are the security measures they have in place with the strategic partner that you are looking for. The other area is the continuing education. So you need to know about what continuing education model the strategic partners have in place. The team is unable to have the updated knowledge within the tax laws and all important updates going around. The third area is you need to make sure that what experience level and the knowledge the management and leadership team has, because underlying team of the strategic partner is going to take help of the leadership and the management team. So it is most important to know that what exactly level of the management and leadership skills have and the experience they have they worked within this industry prior to, are they having the experience working within this US accounting and tax industries, advisory industries or not. What are the models strategic partners are offering? Is there flexible enough to cover your needs? Is their team able to communicate through video conferencing, or they are just considering to be there on the email communication or the voice communication? So those are the measures that should be taken care while taking care about and finding the potential strategic partner, I believe. Amit, you can add on if anything is there.
I echo what you just stated about, like it's extremely important, like data security is a prime thing, and considering the shortage of the staff, it's extremely important to see that stability, that staff retention ratio, that how you will be able to continue and to have that relationship, because if there is a staffing issues, end of the day, it's going to affect the quality as well. So yeah, I will echo on the same things that you just stated.
Outstanding. Outstanding. We have one more question that just came in, and it's asking, is it a myth that co-sourcing and outsourcing is really just for the larger accounting firms? Maybe you can shed light on some of your clients you work with globally, which I would assume you're working with firms of all sizes, correct?
Yeah, and to answer this question, like in my opinion and based on my experience, outsourcing can be evaluated by every level of firm, and not just the large accounting firm, and not just only for a basic level of services. I think there are a couple of models one can consider. One of them is a captive unit, where you set up your own office in India, and other option is having a strategic partnership, where you have trusted partner with a depth of capabilities, experience, and resources who work according to your expectations using your processes. And under this option of like strategic partnership, you must see that your strategic partner should be able to cover the core functioning area of your business. As yes just stated about like what you should consider. So this is one of the item like when you are in strategic partnership, you should consider. And when it comes to working with a strategic partner, it is important to consider few things like they are not just doing the basic service of simple tax return preparation and bookkeeping, but are able to match your business expertise and knowledge to handle the complex services like tax planning, tax projection, tax structuring, specialized tax services, audit and attestation, and so on. It's also important like to consider the scalability to cater the various needs of diverse area of your practice. So to summarize, like answer to your question, I would say outsourcing is for every level of firm, whether it's a small firm or a big firm. um, and it's not just for entry level of like work, but it's a range of services, and that is the reason it's extremely important that you choose a right strategic partner.
Understood. Maybe, Appa, you could launch the next poll discussing for those that are currently outsourcing, what percentage are they currently either co-sourcing or outsourcing? If everyone could take a moment.
Yeah, done.
Fantastic. It's like the numbers are coming in. So it looks like the overwhelming majority, 50+%, is less than 10%. And then the next highest is between 10%, but less than 25% at about 20%. Outstanding. Outstanding. And I think, again, when you're looking for subject matter expertise, you're looking for assistance on a co-source or outsource basis, this is a tremendous, tremendous model for firms of all sizes to consider. And that leads us into the next segue of how firms are growing. And Alan mentioned this earlier with building out advisory practices. And within many advisory practices, people might think CFO advisory services with turnaround CFOs or fractional CFOs, coaching of new CFOs that are coming in, setting the goals and objectives for the next 90 days are critical. But one of the areas here in the States, especially, firms' growth is coming out of what I'll refer to as federal tax credits and incentives. And we've got two great panelists that are going to discuss what they've seen. You've got Kevin Marshall, who over the last 2 years has been building a substantial tax practice around the employee retention tax credit. So much so, he decided to build his own proprietary software that helps taxpayers identify, gather, and document that particular service line. We're also going to hear from Bruce Johnson to talk about what he's seeing on the specialty tax side, primarily on the cost seg side, but he also handles energy, R&D credits, and others. And these are really going to be significant streams of managed revenues for accounting firms as they collaborate and get that subject matter expertise, again, to co-source or outsource that so that their clients are being able to be properly serviced. Maybe, Api, we could launch the next poll question on the employee retention tax credit and then see if we could have Kevin respond.
Yeah, Peter, let me just jump in because as I told you, I need to go at the top of the hour. My CFO is leading a virtual staff meeting, but I need to be there to launch the call as the CEO of the company. So I'm going to echo Alan here. I wasn't even planning on sharing this all, but I couldn't agree more with what Alan said. To go down the list of what we do, right? I don't call myself a partner. I'm the founder and the CEO of my company. I have non-CPA partners. I have a management team. We have regular management meetings. We have offsite meetings. We have planning sessions. We have KPIs. We have company cars. I have a sales team. We have customer service team. We don't run like a CPA firm. We run like a corporation. I don't even think of, I mean, yes, we are at the core of who we are. We also have an insurance agency called Insuretopia, because right, to go along with Profitopia. And we have staff on 3 continents. I just hired our first staff in Ghana. I saw somebody in the chat said that they were from Ghana. So we now have staff in 3 continents. So yeah, I mean, that's where the profession needs to go. I've been a CPA for 35 years, but I couldn't agree with Alan more. So one of the ways that we capitalized on all of this was the ERC. And I'm looking at the poll, and it looks like a lot of firms are currently doing ERC in-house. And I guess good for you for doing that. In our experience, we find that most CPA firms are not doing ERC in-house. So yeah, right from the beginning, we jumped in. We've made millions and millions of dollars off of fees for the ERC. So we've had an amazing ride. And then for those of you who are not familiar with ERC, just so that you know, it's filing amended tax return 941Xs for 2020 and 21. And the statute of limitations is 5 years. So there's still another 4 years that we can capitalize on the ERC and help our clients and help fellow entrepreneurs and business owners in the US. The average refund that we've gotten for our clients is 90 grand, $90,000. So it's, these are not small dollar amounts. So what we decided to do, so we are one of the leading experts on ERC in the country. So I've written a book on the ERC. It's for sale on Amazon, both in Kindle and audio version. We've just launched an app in the last month. We have the only app in the App Store on the employee retention credit. And as Peter mentioned, we also created software in-house. So for those of you, it was 58% of you that are doing the employee retention credit in-house. Guess what? I know how you're doing it. You're doing it in Excel spreadsheets. And I can also tell you that it's not being done properly. Thank God for my staff and for my management team. My CFO decided to test a few other firms, and we sent some test cases to some other firms. And in every case, our software beat the manual hand calculation. So not only is it calculates a bigger refund, but it also does it quicker, faster, and more efficiently. So we have a technology company, right? So here we are, we're essentially a CPA firm at the core of our essence, right? But we have a technology division. So we're not going to stop there. I'm already writing my second book. I do public speaking. And then our next, and I know, Peter, I've already shared this with you because I'm very excited about this, is that our next piece of software that we're going to develop is the R&D tax software. So I can't find anywhere out there where there's R&D tax software that integrates with QuickBooks. So it'll integrate with QuickBooks. Our software, our ERC software, integrates with QuickBooks. Why? And it should. Why shouldn't it? So yeah, there's just so many opportunities out there. And again, I'm just repeating what Alan said. Oh my gosh, there's so many ways and opportunities for us to add value to our clients. I loved what he shared as far as, 150 years ago, we're carrying on like the way the profession was 150 years ago. Our clients don't want a tax return. They want us to be knowledgeable about their business and help them. And they turn to us for that. And so, we can help them in so many ways, insurance and tax credits and, coaching and consulting. So, yeah, I'm just a big fan and proponent of, adding ancillary services, and we don't have to have them all in-house. We can, partner with people to, like our insurance partner that provides the actual insurance. We don't have to be experts in insurance. We can just partner with the right people and, being able to outsource and co-source. So, Yash and Vivek, thank you again. Good to see you. And I'm looking forward to seeing you in Vegas at Engage. We will be exhibiting at Engage and selling our software. So now that we have created our own internal ERC software, the latest version, I was going to say version 2, but it's probably like version 22. If you've ever tried to develop software, it's a never ending process. I've never developed software in my life. I'm a CPA, right? But I surround myself with people who are smarter than myself to be able to accomplish all these things. And so our latest version of the software is we're selling to CPA firms. So we'd love to talk to anybody who's interested in licensing our software. So you think about it. I don't know. I'm of the age. I don't know who else here is of the age. I graduated college in the late '80s. We used to do tax returns by hand. We used to fill in the fill-in forms, right, and send them off to a processing center. Oh my God, who does that anymore, right? That was 35 years ago, right? But it's the same way with R&D tax credits, right? And the calculations are being done by hand. Why should they be? The technology exists. It should be done all automatically through software. So that's what we've done. We've created this amazing software and this tool that can be added into a CPA firm and create a whole new revenue stream and a whole new division without even really having to know much about the ERC or with the R&D. So, I know a lot of CPA firms shy away from tax credits and they don't do them. Peter, I know you're the exception. You're like the R&D queen. And that was a poor choice of words, right? The R&D king, I guess, right? It should be the R&D king. But anyways, so yeah, I don't know if you I just love my job. I love what I do. I get to travel the world. I get to speak. Oh, one more thing I failed to mention is Alan mentioned about a shortage of accountants. So my opinion is we all need to own that, and we all need to do what we can to solve that problem. The way that I have chosen to solve that problem is I've created a foundation that finds people who are underserved and disadvantaged and train them in the art of bookkeeping and accounting. And I mentioned Ghana earlier, so we've hired, her name is Patience. We've hired our first person through the foundation. She lives in Ghana, and she's going to work for us initially, and then we are going to sponsor her and bring her over to the U.S. So I feel very strongly about this. I love the profession. I'm getting goosebumps just saying that. Because I've been a CPA for 35 years. It's at the core of my being. But please, we just need to do things differently. We need to get into the 21st century. We've already, a couple of other things that we've done. We've raised a couple of $1 million. We're in the process of, in the next 30, my staff's ready to kill me. In the next 30 days, we're acquiring 2 more CPA firms, right? But, and these are what Alan was talking about, 100% tax. They don't do anything. They don't even do comps, reviews, audits. They don't do bookkeeping. Right? They just do work the old fashioned way. And no, I mean, we're going to add all our ancillary services and be able to really, really make a difference in the lives of our clients. So that's me. That's my spiel. Alan, thank you so much for starting us off with all those great kind words and accolades and charges and the opportunity to be able to preach, right? To be able to say, hey, come on, you guys, get with it, is essentially what he was saying. And I couldn't agree more. I mean, I'm drinking the Kool-Aid myself. So we have a few more minutes. I don't know if Peter, you want to ask me any questions, or I can't believe.
I think you hit a...
I can't believe I got that done in like 7 minutes. So, I mean, my staff is really proud of me. So
I think you hit upon some really great points. Clearly, automation is transforming the profession. You mentioned, going back to the late 80s, early 90s, with how the profession changed from doing returns before the advent of everyone having their own laptop or desktop at the firms. And, even if you look at today with statistical sampling software for transfer pricing, the automation continues to evolve with artificial intelligence and machine learning. I think that's to clearly mitigate risk, as well as to optimize the potential value of some of these credits or deductions, different types of incentives. No different than when you're filing a tax return. You can't e-file that return if you have overrides. They're going to give you a checklist. Did you consider all these? You have to clear every single one of these before you're able to e-file that return. So automation is going to continue to transform the industry. And I would love if Appy could put the next poll question up on cost segregation, because Bruce Johnson's the founding partner of Capstan Tax Strategies and is one of the foremost leaders in this space of fixed assets, handling cost segregation, construction tax planning, TPR compliance services. And he handles some of the most complex structures: hotels, casinos, shopping malls, office complexes, commercial, residential real estate. And it's so exciting to have Bruce on today's broadcast. I want to hear from Bruce to see what he's seeing, because when you think about accounting firms' advisory practices from a tax advisory standpoint, which 25 years ago, the big six firms were calling it tax consulting practices. Now they're calling them advisory practices, tax advisory practices. One of the most significant streams of new managed revenue to firms fall into federal credits and incentives. And clearly cost segregation is one of those areas. And it's really, if you will, evolved over the decades to where in the old days, accounting firms would have accountants looking at the property, plant, and equipment download and asking, okay, let's call it fixed asset review. And an accountant would take something that is abundantly obvious, like a wall sconce or flooring, carpeting, to figure out, is it personal in nature with a 3, 5, 7-year class life? Is it a land improvement with 15? Or is it going to be real property, 39 and a half years in the case of those office complexes and shopping malls, hotel, casino structures versus commercial residential real estate at 27 and a half years. But over time, they realized the value of hiring subject matter experts that were engineers or architects, design, build, contractor backgrounds to really go deep. And then you're looking at what's behind the walls, which is cost segregation, and even construction tax planning, which is even before the building gets built, to make recommendations as far as what could be, pre-planned for the structural integrity test. So it will fall into a personal category. Bruce, let me hear from you, see what you're seeing. You work with accounting firms across the country. I see the poll results, and it looks like there are some firms that do it in-house, but the bulk is they refer it to third parties at 33%. Maybe you want to comment on that, Bruce.
Yeah, Pete, thanks. It's been great just to sit here and listen to the discussion because as, excuse me, Kevin had said, Alan teed things up very, very well, I think, because as you just mentioned, we have a great opportunity to work with a host of CPA firms around the country. Being a consulting practice that plays in the world of engineering and tax, but does not have the need to be signing returns or labeling drawings as a professional engineer, we have the ability to kind of work with these firms and really listen to their individual goals and what their challenges are. And it's just interesting, certainly from my perspective, being in this industry for going on 19 years now, when we started this practice, things have certainly evolved like we've heard from everyone. And we certainly as an organization struggle with a lot of the same type of shortfalls in terms of staff, in terms of time. Time is not something that we can replicate. So how do we manage that better and get the most out of our time? It was really interesting to listen to Kevin and his evolution of software. And certainly we at Capstan, although we haven't got something that is automated, we have developed our own software through certain platforms that really help us to perform at a higher level and able to do more with less, essentially. But really, when we look at the CPA community, I mean, we all know about this. There's been some great discussion on this over the last hour. But I would just add that when I look at my interactions with CPA firms, they're all looking for ways to add value to their clients. And while doing that, add margin dollars to the firm that they're with. And so when you look at these consulting practices, they typically lead to maybe higher margins and also allow them to talk to a higher level client. So in my world, we work with anywhere from top 15 firms down to sole practitioners and everything in between. I don't know the exact number, but at least a couple hundred different CPA firms across the country work with us on a regular basis. And we understand, we just being around them, understand some of their challenges. So as a consultant, we look at our role is to help force multiply, if you would, their abilities and their focus. Again, to really be laser-like focus on what their goals are to be growing their practice. And what our experience is that it typically falls into three categories. They simply just introduce a firm like Capstan to their client and away they go on separate paths. The CPA gets pulled back in when the report is done and use that to file the tax return. There's also kind of a hybrid formula where, as opposed to that, or the consulting firm acting as a strategic partner behind the scenes, what we call white labeling a report. So it'll be a private label report that goes out to the CPA's clients. In many cases, that's a seamless interaction, meaning that the property owner or taxpayer doesn't even know that they're working with a third party. They just see it as one team. And then there's a hybrid. The third part would be a hybrid where it might be a situation where the CPA is controlling the relationship, but they are really also bringing in this third party like Capstan to perform the work. So I like to call that kind of the three legs of a stool. So you have the taxpayer, the tax professional, and the consultant ultimately driving these solutions. Because when we really look at these, this is a point that I'd like to make. What I really like about what I do is it doesn't always fit a scenario because of a variety of reasons. It might be that that taxpayer is just not ready or in a position to leverage the type of deductions that can be generated from a lot of these tools that we interact with. But it's sharing the idea. It's putting that thought in their mind that the team that's in front of them is providing an idea that might be useful today, might be useful to tomorrow, and helping them to maybe freeing their minds up a little bit that, all right, I've got this, if you play cards, I have this ace in the hole that I can play when I need that cash flow. And as I watch the professional tax community, this gives them a real opportunity to share what they know. And particularly what I see a lot of using these types of services for CPA practices that are going after a new client. They use this as a wedge service. So when it comes to how do they get this done, I mean, certainly we have an independent practice here, but we also know and have watched some of our larger clients transition from a relationship with a third party to internalizing this. And we kind of we've looked at the economics of this in a number of times, and it's certainly the economics are important to see what type of profit or margin can be driven to the bottom line. But there are the intricacies of really running this type of practice. And in my experience, while this does, because it's a tax service, it is a different type of practice to run. And how things like, all right, staffing, certainly for those of you that maybe know an engineer, you certainly know a CPA, we can all go find a number of great schools out there around the world that will provide a way for us to be able to get that type of degree. But there is no school for cost segregation. There are a few books that will give you a high level understanding of it. But the reality of what we do, Peter, is we blend these two distinct professional disciplines into a service with the ultimate goal of driving a financial solution. So what you find is that this is a homegrown pool of talent. And similar to, as we've heard from a number of your panelists today, our industry is no different than any other than it's a much smaller niche market. So as you had mentioned early on, under the component depreciation days, CPAs would be able to do this. All that really changed when cost segregation came about. The term cost segregation came about in 1997-98. The IRS issued an audit techniques guideline in 2004, albeit a guideline, not law. It really outlines how the IRS wants things to be done. If you look into the fine print of that document, it talks about the preference being a third party, preferably an engineering-based, talent-based focus to be able to forensically break down these commercial real estate assets, in this case of cost segregation, into its pieces and parts, and then applying tax law to that. So when you look at all of that, and the fact that the IRS does stress independence between the level of people involved, the taxpayer, tax professional, and the consultant, you really and then you overlay the economics that I've discussed, really the desire to be able to drive a different type of dollar amount to the bottom line. And then you add the other variable of staffing challenges. It really opens up the question, okay, as a CPA firm, what do I really want to be? Do I want to be good at what I do and outsource the rest? That really is an important question, because I know for my business, it was interesting to hear Alan talk about the last 2+ years that if you haven't been growing your business, something's wrong. Well, certainly a lot of peers, as well as Capstan in my little industry, have had that challenge. It's super hard to find talent. And certainly, you could throw more dollars at them. But nonetheless, if you're a CPA firm looking to do this, I would encourage you to be thinking not just about what this could mean from adding it to your service base, the bottom line profits, but think about managing staffing and running that type of department. I'll give just an example, Peter. In tax season, obviously, there's this whole thing called flexing. And so that's one of the things that an independent firm like Capstan provides a CPA practice is certainly you can have a bench for your known workflow on an annual basis. But what happens in tax season when you hit 3, 4, or 5 portfolios that all have the same deadline? And so when you look at everything that needs to get done, it really poses a challenge. So I think that from my experience and being with a lot of different CPAs of different sizes that have just gone through this discussion, there certainly is an inflection point that it really makes a lot of sense to move it in-house. But you might be surprised at what I think that dollar volume is for you to get to that point. And even with that, are you going to be able to meet a lot of the needs that your clients are laying at your feet, so to speak, as you start to really go after this hard? And the other thing too is I'd say there's a competition. I see competition within CPA firms because, again, as I mentioned, time is an incompressible resource. We can't make it. So really the time and effort to go after some of these services, I find a lot of CPA firms focusing because of the volume of opportunities, and they can only have so much time to go after them. They're going to pick and choose which service they're going to lead with. So I know, Pete, your knowledge base in R&D is bar none best in the industry. So I find R&D is typically, if that is in play, that's where people are going to focus first. And then services like cost segregation or TPR compliance are going to be a distant second or third. So again, it comes back to, as a CPA firm, what is really the strategy behind the why behind internalizing a service like this? And how can I best meet my needs as well as my clients' needs?
Outstanding. I think when you're working with different accounting firms across the country, Bruce, they vary in size, correct? You could be working with top 50 firms, top 500 firms, correct?
Absolutely. Yeah, anybody that has some form of real estate focus is typically going to be looking to provide these services. And for us, certainly no different. We're looking for those type of firms.
Yeah, one thing I want to point out what Bruce does is it's really critical. It's not just accelerating component depreciation properly to get into a lower tax bracket to pay less taxes. It really sets the tone. So when a taxpayer purchases a building, without that cost segregation study, you're not going to be able to know what the cost basis of each component within that building envelope and systems are. And what ends up happening is when you're making repair and maintenance, when you're incurring those repair and maintenance expenditures down the road to ensure that you could actually get those components, as an example, to the point where they could be fully depreciated. So take, for instance, a rooftop. That's going to be a 39-year asset. And ultimately, if you place that building into service and you didn't do a cost seg, you're basically taking the whole purchase price outside of the land, which is non-depreciable. But what happens if 5 years from now, a storm destroys the roof and now you've got to replace the roof? You're going to take the new cost of the roof and capitalize it. But without the cost seg study, you'll have a ghost asset on your books because you'll be continuing to fully depreciate an asset that was abandoned because you took it out of service before it was fully depreciated. And that goes for everything: the windows, the doors, the HVAC systems, the wiring. The repair and maintenance costs can be astronomical to maintain buildings. And to get that number correct, the starting point should be a solid cost segregation analysis to make sure you're setting up that conceptual framework properly for your fixed asset registry going forward. Would you agree, Bruce? Do you want to talk a little bit about that, or?
Yeah, I think that, when you're looking at the real estate profession and all the challenges that they have, taxes are typically a necessary evil. And then when it comes down to our little piece of this, it's usually thought of at the back end, which brings up another thing to keep in mind. And from the CPA's perspective, is having the time to think through a lot of the details you just laid out. I mean, it's not just about accelerated depreciation. It's about preparing to make future decisions on your property, laying the groundwork for future decisions. And the wonderful thing about our little world now is there's tremendous opportunity, so much opportunity as a result of the Tax Cuts for Jobs Act, that it presents a lot of opportunity for savings. But with that opportunity comes a higher degree of complexity and the need for a level of detail of data that it's not easy to come by. And getting back to, as I mentioned, historically, when it was component depreciation before the Tax Reform Act of 1986, that was typically done by a CPA. And now everything has changed, whereby, as I had mentioned, the audit techniques guideline and how it outlines how a study should be done. But then you start to look at all of the different opportunities that are at the fingertips of people in real estate. And it's interesting that just the last 2 weeks, I've talked to 3 property owners or investors that have started off small, and they're now getting into a much larger, more complicated deal structure. And each one of them have asked me to say, listen, I think I've outgrown my CPA firm. In many cases, a sole practitioner, because they need that different level of service, that different level of creativity, if I can use that term, to be looking at their tax return and making sure that they are getting full advantage of the tax code for them at the next go around. And every year those metrics, that equation can change. So I think that there's a demand being placed in the CPA community, in addition to just wanting to be able to offer their services and drive more dollars to the bottom line. But there's also the idea of being able to meet the needs and have high level discussions with clients. And so when you look at how do you get that done, we talked about the 3 models. You've got in-house, 100% outsource, or hybrid form. The answer differs from practice to practice. And really, it's interesting to me, it doesn't matter the size of the CPA firm. It really doesn't. It just comes down to where they want to be focusing their energies on. And then if they want to internalize it, fantastic. But if they want to outsource it, to be able to have a team member, a partner that's going to be there to help them every step of the way and make their client feel no different, because there's this outside firm helping them out side by side with the CPA right there.
Absolutely. I think a lot of accountants, some realize it, some don't, when they're having discussions with their clients around the portfolio of properties that they may own. It's not just purchasing that building. You could have a situation where they've owned the building for years, but they decided to put a new wing on the existing building, or something as simply as a couple of tenants moved out and you had to basically strip down to the studs to rebuild a new floor configuration layout. So let's say you had a startup tech company leaving, and now a law firm or an accounting firm is moving in, and that landlord has to reconfigure that. Those leasehold improvements could be a cost seg study on that one floor, especially in super cities like New York City, LA, San Francisco, Boston, Chicago, and many others across the nation. Wouldn't be uncommon to spend 7 figures in renovating a single floor. And that could be enough to do a cost seg study. Would you agree, Bruce?
Absolutely. And we've got so many examples of properties that, although not as many, but so many examples of people that have been, say, we're into the 2nd or 3rd generation of a family-owned developer business, and you're not looking at the building itself, you're just looking at the improvements, because the building was first placed into service in the 1960s. So, I mean, this just kind of gets to the level of complexities that are involved in real estate, and having the time, the talent, and the focus to be able to go through what those are and really understand the opportunity and present it in a concise and manageable fashion. Not just to throw something up against the wall and say, hey, let's try this, but we've vetted this as an opportunity for you, and here's really what we think the benefits could be for you.
Sure. There's a myriad of different scenarios, clearly. It could be, the purchase of a building, could be new construction from scratch. It could be the inheritance of a building where you get that 754 step up in basis. So it's really important when you have clients to really take a close look at what's in that property, plant, and equipment category and have real-time discussions. And like you mentioned, Bruce, bring someone in that's got that technical subject matter expertise. The accountants and attorneys that handle the returns clearly are going to still have to work on the 3115s, the change of accounting method forms, and other matters, the 4562 depreciation amortization forms. There is plenty to do on both sides to share the revenue in this. And again, just a tremendous opportunity for firms to grow new streams of managed revenue as part of that tax advisory practice that I'm seeing just tremendous opportunities, firms of all sizes for this service offering. And it's so complex. You mentioned the audit technique guideline is what the IRS agents use. So if an exam comes to fruition, that's exactly what the agent's going to use as their blueprint, so to speak, and looking at what's going to have to be checked off qualitative and quantitative wise. This was incredibly insightful. Thank you, Bruce. Really appreciate that. And I want to thank all of our panelists, all of our participants. A special thank you also to the members of the board of directors of the Northeastern Region Tax Roundtable that were on today's call. And also, many of you know me as a federal credits and incentives practice leader, but others know me from my philanthropic works. I see a lot of council members from the Accounting Industry Leadership Council to benefit the Alzheimer's Association on the call that are working for other accounting firms. Thank you for joining and participating. Special thanks to our sponsors, once again, Infinity Globus, Capstan Tax Strategies, and Profitopia. Really appreciate it so much. Any closing comments, Bruce or Vivek, Yash, Amit?
Yeah, Peter, I think that thank you so much for coordinating and hosting this webinar. And this is really a very, very, very thoughtful from the Alan, Bruce, Kevin. I think that for the accounting industry, the latest trend of the accounting industry and the approach, this will be a very, very useful for the attendee. Okay, so thank you so much, Peter.
You're most welcome. Thank you.
Yeah, Pete, I'd say echo that. Just thanks to you for setting this up. It's great to listen to some awesome presenters here, learn some different things. And if there are any other questions that people might have as they filter in afterwards, certainly I'd be more than happy to help out. But again, really appreciate the opportunity. Thank you.
You're most welcome. Take care, everyone. We'll see you on our next broadcast. It'll likely be in July. Thanks very kindly.
Yeah, thank you so much, Peter.